Hello, this is Julius from Basic Financials. Today I'm going to talk a bit about pension contributions. I've covered this in the past or as part of this in another video, but I heard on the radio yesterday that a very high percentage of people who can be claiming extra tax relief on pension contributions aren't. So I thought, well, this would be a good video to do to try and help those people who aren't claiming what they could do. I think the reason why it might probably happens is because people think the pension contributions are being taken out of their pay. It's all being dealt with by their employer and the tax office, which is correct to some extent, but not completely. And also the pension company won't be dealing with the whole thing, they'll be dealing with part of it. Now, for example, let's say you're in a pension scheme with your employer, and they're taking off pension contributions from your net pay. So you've got your normal pay as you might have done before you started having contributions. They take off your tax and your national insurance, and you're left with a net figure of pay, and they then take off your pension contribution. When that's taken off, it's taken, the amount that gets taken off your pay is normally 80% of what the actual gross pension contribution is. So, for example, let's say that you have £100 gross pension contribution. What you would actually see come off your net pay would be £80, and you get, so basically you've had tax relief at source. That's what it's called. So you pay £80. That £80 will get paid by your employer over to your pension fund, and then the pension company will claim back the £20 that will make it add up to the £100 gross. So that's where your tax relief comes in. Now that's fine, so long as you're not a high rate taxpayer. If you're a high rate taxpayer, which basically means if your income is more than, well, for the year ended 5th of April 2019, so the current tax year that we're in, if your income is over 46,350, then you would be a high rate taxpayer. You would be entitled to more tax relief on your pension contributions, because what those pension contributions do is they increase the amount of tax you can pay at basic rate. So if you pay £100 gross to your pension company, i.e. you'd have £80 taken off your net pay, then that £100 increases that 46,350 starting basic rate level that I was talking about, increases it by £100. So whereas on your payroll you will have paid 40% tax on £100 in your pay, you actually should only have paid 20%. Now, the way you claim that extra tax relief is probably another reason why people don't do it, is because you need to submit a tax return. A self-assessment tax return, and people probably think, oh no, I don't want to do that, get involved in doing tax things that I don't have to, but it can be really worth it. I mean, especially if you're making pension contributions to a private pension scheme on top of what your employer's taking out, you could end up, if you're paying £8,000 a year, that's £2,000 worth of tax relief that you're not claiming back. You're probably getting the £2,000 basic rate to take it up to the £10,000, but you're actually entitled to another 20%. Now, it's not too difficult to set yourself up so you can complete your own tax returns. It will mean you'll need to start putting all your income details into that tax return, not just the figures that you're claiming. You actually have to show your gross salary and the tax deducted. You have to show your interest received and your dividends received from shares if you've got any. And you would also, in your tax return, say that you're paying pension contributions. You enter the amount that you're paying in, and then that's when HMRC will be able to calculate your tax refund if you're due one, and you'll either get a refund or they'll make some adjustment through your tax code, so that they try and give it back to you over the years. But the best thing to do is to do your tax return every year, and then you'll know things will come out in the wash, even if they get your tax code wrong. I've talked about tax codes in previous videos as well, how they can go wrong. So if by doing a tax return, you know everything is going to be right. You go on to www.hmrc.gov.uk and you can register to complete a tax return online. It's a two-step process. You first of all set up a government gateway account, or what they're now calling a personal digital tax account. And then once you've done that, you then will register. I think you get your activation, your login, and you create your own password at that point. But then after you've done that, you then register for self-assessment service, and they will send you a unique taxpayer reference, or UTR, which is 10 digits, and they'll also give you a activation code in the post, so you can activate the service, and then you can now go in and prepare a tax return. And it's fairly straightforward. It's easy for me to say that because I've been doing it for 30 years, but it's the starting point is they ask you some questions which eliminates an awful lot of the tax return information that you don't need to do, and this just leaves you with what needs to be put in, and it's fairly self-explanatory, so you can give it a go, can't you? Yeah, I think that's probably all I should say about that, but it's definitely worth looking further into it. If you're a higher rate taxpayer, so your income's around about 46,350 or more, goes up each year, that level, and you're paying pension contributions, you need to make sure, well, you don't need to, but it's a good idea to make sure that you're getting the extra tax relief on your contributions, not just the basic rate tax relief. You get basic rate tax relief at 20% of the gross contributions. You're entitled to another 20% if you're in the higher rate bracket. Okay, we'll leave it at that. As usual, if like and subscribe, and give me any comments or suggestions on anything you want me to talk about. I'll see you soon. Bye.